Hey, this is Trader Travis, and I am back with my 5 rules of stock investing, part 2 of 2. Before we get started, a quick recap of part 1. And if you're wondering, he's wearing the same clothes as yesterday. No, I just ran out of time for the first video. I was like, I'm already here. I might as well just keep recording anyway. And I also didn't talk about this. It's not like a club band or anything like that. It actually has something to do with what I'm going to share in this video as a PRI investing strategy, and I'll get to it a little later. So again, this is part 2 of 2, and I'll really quickly recap the first 3 rules we covered in the first portion of this training. And that's rule number 1, only buy assets. Rule number 2, no more than 10% of your net worth or how much money you have invested in the stock market goes into any one individual company. And then rule number 3 is balance your risk. And in the first portion of this training, I covered all 3 rules in more detail. So now what I want to do is move on to rule number 4, take your profit and run. This is optional, but it is a good risk management thing. Sell half of your stock position at 100% gain and then leave the risk-free shares as a set it and forget it trade. And what I mean by risk-free is, you pretty much, what they say, playing with the house's money. You invest $100 grand in stocks and then they double in price. You have $200,000 now. Your account has increased to $200,000. Well, if you sell half of that, you take $100 grand off the table. You take your original risk off the table, and then you're playing with money. I don't like the word playing. You're investing with money now that the market gave you. So it's a lower risk position in my opinion. And this is, if anybody's followed me for a while, you see I do the same thing with my option trades, right? If they double, more than double, often you'll see me take that profit off and then reinvest just my profit. And what that does is just protect my original investment. And we'll get to that here in a second again about protecting my original investment. You'll see that here again when we get to our 2 bonus rules. Now, number 5 here, don't be dumb and reckless with your money, right? Don't be like the old Trader Travis, right? Where I used to I'd buy a stock and it fell in price. And I'd be like, oh, let me buy more. I'm lowering my cost basis. Whatever. Never, ever buy more of a stock if it falls unless it was money already allocated for that stock and it was a planned event. Keyword there, it was a planned event versus an emotional event where, again, you lie to yourself and you say, I'm lowering my cost basis. No, you're chasing after a losing stock. You're trying to get back. You're revenge trading or revenge investing. You're trying to get back something you lost. It's an emotional move, and it's how people go broke, right? Let's get back to common sense. We invest in businesses. This is a business, investing your money. So would you put your money in a failing business, i.e. falling stock with falling revenues? Or do you want to put your money in a successful business, a business that's rising in price, like the stock is rising in price and profits are rising every year, right? Let's use common sense. Sometimes when we get emotional, common sense goes out the window. Now we're going to move to our 2 bonus rules here, right? And that is, don't be an amateur. Instead, be a professional manager of risk. So the first bonus rule is, if you can't afford to take a loss on the stock, then buy insurance for it, right? And insurance is called protective put options. If you search protective put options online, my YouTube channel, you'll see a video I recorded on it explaining this concept. But the best way I can explain it is by demonstrating what I actually did. So here is a trading for a living case study I profiled in 2019, showing individuals, hey, if you complete the 5-year retirement plan I teach the Success Academy members, how to achieve financial freedom in 5 years or less. If you achieve and complete that, how do you live off your portfolio? So I profile that. Well, if you're living off your portfolio, in my opinion, right, you can't lose money, or you can't afford to lose money. You're living off of that. So when you lose money, you're losing income, right? You're losing your ability to have a pretty fun and fulfilling retirement. And so I showed them here. You see insurance total, it was a $352,000 account, and I spent $60,000 buying insurance, protective put options. So that was nearly 20% of my account. Yet I still wound up with a profit of $250,000 for the year, despite me spending $60,000 on insurance. If I didn't spend money on insurance, I would have had $300 grand profit. But for me, investing is about managing risk. It's not about making the most money. And so I'm not out to make the most money. I'm out to lose less than everybody else. So I still had a decent profit even despite spending money on insurance. And why I did that? Because again, if I'm living off my portfolio, I can't afford to take a catastrophic loss of 40 to 50% like other buy and hold investors. So that was the first bonus rule here. Second bonus rule is ideally never use your own money to buy stocks. Use their PRI strategy instead. So what is the PRI strategy and what does it have to do with this wristband here? Well, I just had, I guess you can call it a daddy-son date. We have this thing, well, we went to this thing called father-son camp a few years back where just dads and their sons go out in the woods and they shoot bow and arrows, things like that, right? But my 4-year-old couldn't go. He was too little at the time. So when we came back with when I came back with the older two boys, he was like, "Hey, Daddy, I want to go on a trip with you too." I was like, "Okay, let's do that." But we had to come up with something that was age appropriate for him. So we had a staycation. Today, as a matter of fact, today. Anyway, we drove like 40 minutes away from our house. Just got a hotel room, poolside suite, where you can just walk out to the pool, things like that, and then took them to a trampoline place. So this is the wristband for the trampoline place. So all of that costs money, especially the $40 I spent at a trampoline place, right? I'm like, that's not a good value for my money. It was a good value watching my son have fun. The 4-year-old has fun, but not good value is I'm paying $40 just to walk around and make sure he doesn't break his neck, right? So I'm not having fun. I'm like, he's having fun, right? Anyway, the point here is that it wasn't my money, right? It was the stock market money. All of this entire weekend and poolside suite, the jumpy place, paid for by the stock market. Why? You have to thank Robert Kiyosaki, the author of Rich Dad, Poor Dad, who taught me that, hey, when he wants to buy a brand new car, he first works to get an asset to pay for that car. And I was like, that's a pretty smart principle to follow. Despite my wife's accusations, I think that spending money is stupid. I'm like, no, I think spending money like a poor person is stupid. When you spend your time and energy, your life energy at a job, and you deal with all kinds of crap, then you come home, you take your paycheck, and you buy an iPhone, a $500 iPhone, right? Yeah, I think that's a stupid way to spend money, because guess what? Then you got to get back on the treadmill. Off to work we go, earning more money because you just spent it on a liability, something that takes money out of your pocket. I said instead of taking that money and then buying or accumulating an asset, then have the asset pay for the iPhone. You're still buying an iPhone, right? I don't have any problem with spending money if you spend it that way. But if you're going to take my life energy and I'm going to work every day and I'm earning money and you just squander it, so I got to go right back to work, yeah, I don't want to spend money that way. I'd rather get an asset and accumulate a trading account or something like that can pay for all the fun stuff we want to do. That is the same concept of the PRI investing strategy. Next thing, mortgages, cars, same thing. If you want to buy a house, right, most people are going to have to get a mortgage. Then you hold off on buying that house until you build your trading account up enough to the profits can pay for the mortgage. That is following, again, that PRI investing strategy. The same thing I did for this weekend, just on a bigger scale. This was a weekend that probably cost a couple of $100. Mortgages will cost a whole lot more, but it's the same principle. So what is the PRI investing strategy? And what does PRI stand for? It stands for profit reinvestment. So let's come back to my Excel and I will explain what this is. So again, I had a $250,000 profit in this account. And so what the PRI investing strategy is, and it goes back to investing in individual stocks. I don't want to use my original capital, money I've worked hard for, the 300 grand I worked hard for. Instead, I want to risk my profit. So if I take the 250,000 and 134, then that is profit the market gave me. I take that profit and then I use that to buy individual company stocks. I don't have to follow the 10% rules, right? I don't, I still balance my risk and things like that, but it's not really risky to me because I'm just using profit the market gave me. And what do I do with these stocks? Well, I sell covered calls on them, so, right? I bring in $5,000 a month in income. And remember, this is not my original money, right? I am now earning $60,000. I'm actually not earning $60,000. I'm earning a whole lot more, and I'll show you in a second. But I'm earning $60,000 a year, and I'm not risking any of my original capital, any of my original money, right? But I actually don't earn 60 grand. I actually earn, we multiply by 2, right? And how do I earn 120,000 off of this? Because as I was teaching one-on-one clients, I found a way to take my covered call income and then leverage it, right? And so that way you actually double your returns. So realistically, I'm earning about 10 grand a month off of this, again, profit the market gave me. I believe that there's no wealth without savings, so you should always have a high savings rate. And I could give another example, maybe in another video I'll teach why there's no wealth without savings. So anyway, I believe you should have a high savings rate. So let's just shoot for a 50% savings rate. So out of this income I'm getting from the market, right, this risk-free income, not technically risk-free, but I hope you get the point, I'm going to save 60,000 of that. So what am I going to do with that? I'm going to add it right back to the money I originally started with, was, you know, the profit I originally started with, $250,000. So next year, I'll have $310,000 to now trade cover calls on and then leverage the cover calls. So I will now be earning $12,400 a month. So in 1 year, I've added $2,000 a month to my income. And here's the crazy part. Again, this is none of my own money. I started with my own money, but once my account generated a decent enough profit, I then took that profit to invest in individual stocks, and then I used those stocks to trade cover calls on. Again, I leverage those cover calls with another strategy, 1 or 2 other strategies. So usually can double, well, at least I won't say I usually can double my monthly return. So anyway, so this is how I tell people in the Success Academy is a training called the Family Freedom Fund. And the goal is to earn 10 to 15% in passive income each year. All right, this is how we do it. I just showed you how we do it. Right? Takes a little bit of effort on the front end, but once you get it going, you can earn 10 to 15% in passive income, because cover calls truly are passive income. It literally, no lie, sounds get rich quickish, but it takes a few clicks of a button each month, and then you're done. You don't have to show up again for another month to see how that cover call worked out. So how did I come up with this prime investing strategy? Well, it came from, I'm over my limit here, I just realized, but I'll wrap up now. It came from me being a bigot, believe it or not. I used to be an active trading bigot, and I used to make fun of, bigots are people who are closed-minded to other ways of doing things. So, you know, I used to make fun of buy and hold investors. Oh, that's dumb, you know, to settle for 7 to 9% a year when you could trade options and earn 15, 30% a year. Well, there's a such thing as a buy and hold bigot too. They make fun of us active traders and say it's a losing game. 90% of traders fail. You know, you can't time the market. Wow. Both of those camps are just dumb, right? If they were smart, and I got out of the dumb camp, and I'm like, if they were smart, they wouldn't be arguing with each other. They would instead be learning from each other. And so once I stopped being a bigot, I was like, wow, let me take the best of both worlds, right? There's a thing called DRIP, Dividend Reinvestment Program. Well, I can take that same concept from buy and hold and then add it to active trading, profit reinvestment, right? Instead of reinvesting my dividends, I was like, wow, what if I reinvest my profits into doing stocks and cover calls and things like that? And so that's where I came up with it. And again, you know, if you stop being a bigot and you learn from people who disagree with you, right? Learn from people who are the opposite of you. You can take the best and the most brilliant things of how they think and then apply it to how you think. And then you come up with these awesome strategies like that. So again, second time I've ran over my 10-minute limit. As my wife says, I'm very long-winded, but I hope you found some value out of this. I'm praying you do, because I'm showing up 5 days. Yay! Right? I only have 25 more to go. We'll see. But anyway, you take care. See you in the next video. Bye-bye.